Hi traders, my name is Mary Redmond. I'm talking right now about the pound-dollar pair. So this pair is very obviously in a long-term upward trend. You can see that there's a trend that started over a year ago, which it's been following. However, I do favor it to the downside this week for a couple of reasons. And you can see that it's kind of sandwiched here between its 200-day and its 100-day moving average. But the primary theme this week is that we've seen so far is a movement away from the stock market and a move towards risk aversion that may come from the end of the Fed's quantitative easing program anticipated and some slowdown in global growth. And the EU crisis kind of appears to be out of the spotlight for the moment. The Troika has put out a statement that they have the situation under control, and which they do. They have the funds available, which Greece needs, and nobody really knows in the long run how many other bailouts are going to be necessary. But that doesn't seem to be affecting the euro this week. I mean, what happened last week was probably there was so much excessive publicity about this and excessive speculation about Greek bankruptcies, and then when we had some good news, there was just an incredible short squeeze on Friday. So this week, the focus is going to be on the central bank meetings. So traders are going to listen to the commentary of really all four of the central banks, even though the Asian central banks are going to affect the Australian and New Zealand dollars more. There's still some impact if the RBA President Swan were to come out and say something like, well, we're expecting robust global growth, or else we're, expecting some type of a slowdown in commodity demand. I mean, either way, it's going to have some impact on the whole market, although the big move in the pound may not come until Thursday. So the main reason why I think this might be a downside move this week, the US dollar is really oversold at these levels. And the employment report, which came out Friday, showed that the slower employment growth probably means the Fed won't be raising rates anytime during 2011. Their move, based on what they've said, is probably going to be to end the quantitative easing in June and to keep these securities on their balance sheet, to reinvest the payments, and to continue to monitor the situation with growth and with employment. But the quantitative easing over the last 6 months has really put incredible downward pressure on the US dollar. And that weight is going to be lifted very soon. We can already see the beginning of a start to sell off in the commodities currencies. And the market is expecting more interest rate increases from the Bank of England this year from the Fed, which will probably still be true. But the more recent commentary from the Bank of England members indicate that right now, and at least for the next few months, they're really more concerned about continuation of growth. And the UK went from a contraction to a fairly slow rate of growth of 0.5%. And the fact of the matter is that there are still some concerns in the economy, despite the fact that they have a higher than desired inflation. The Bank of England members have been indicating that their risks remain skewed to the downside at this point. And Mr. Fisher even came out last week and said he wouldn't be against additional quantitative easing by the Bank of England if the conditions warrant it. So what we're going to see is the Bank of England is expected to leave rates on hold, and we'll have commentary from the ECB, not from the Bank of England. But of course, anything Mr. Trichet says is going to affect the pound as well. So if Mr. Trichet is hawkish, as he has been, that could affect the pound. And if he gives any indication that he's concerned about slowing growth, you could see a big sell-off in both the euro and the pound. And if you look at an 8-hour chart here, it looks like there is a downward channel that's pretty clear here, until this would make a convincing break to the upside, which would probably only happen if we saw a rebound in the stock market and risk appetite. It's likely that the pound could pull down this week, maybe to the top of its rising trend channel, which would be around 61.72. There were a couple of false breaks out of this trend channel a couple of times this year, so it might even go lower. It's a concern whether or not it would actually break. That remains to be seen. but I favor shorting it up around, probably around the 64.5 level if it does reach that this week, alternatively around 64. And we'll have to see what the market reaction is to the Bank of England, as well as what goes on in, with the rest of the central banks this week. But I think the main factor, what you really need to look at, is the fact that we saw a very bearish close on the stock market on Friday, and then we're also seeing bearish moves again today. So we're probably going to need to see a substantial spike up in the volatility index, maybe even to the 28 or the 30 level that we saw back in March, before we see the market turn around to resume a bullish trend, if it is going to. And of course, we don't really know the company earnings warnings, how many earnings warnings they're going to be. We don't really know, exactly when they're going to be coming out during the later part of June and early July. But it really seems that there's a pretty strong move in the market towards risk aversion, and that should probably benefit the dollar, despite the fact that the ratings agencies have been threatening to downgrade the dollar and so forth. It also just seems to do better when the stock market is going down. That trend hasn't really changed.